The volatility indicator is, on the surface, superficially, a very simple indicator. But the information that it reveals to you as a trader is immensely powerful. So let me explain why we developed it, how it works, and then perhaps the reason that volatility is so important. The indicator works on average true range. And essentially what it's doing, whatever market or instrument you are trading, or whether it's an investment vehicle, the indicator works in all time frames and essentially looks at the average true range, scanning the price action to establish whether the price candle is outside the average true range or simply within it. If it's within it, then we might consider it to be average price action for that particular time frame and that particular market. But the moment that the price action spikes outside of the average true range, that is the point at which the indicator triggers, and it triggers with a little purple triangle top and bottom of the price action. Now the important point is twofold. First of all, it is signaling to you as a trader that volatility is entering the market. In other words, we've moved outside the average true range. Secondly, and equally importantly, it fires before the candle has closed. So you don't have to wait until the candle, whatever time frame, has actually physically closed on that particular session. The indicator will trigger before the price action closes on the candle. In other words, as soon as the metric of moving outside the average true range has been met, then the indicator will trigger. And at that point, you know for certain there is volatile price action in the market for that particular chart. So why is it so important to actually see this visually, this visual representation, the alert signal that volatility is in the market? The reason's twofold. Firstly, because what volatility does is it triggers the fear of missing out, FOMO. Fear of missing out is something we all suffer. It's something that's built into our DNA through our evolutionary process. Through which a kill going past our cave, we would actually take it fast moving. We'd rather eat now rather than wait for something which might be more easier to kill, slow moving perhaps, but that day may never come. So we are programmed, if you like, genetically to react to something that is fast moving. So when we see volatile price action in the market and we see something snap higher or lower, our instant knee-jerk reaction is to jump in for some quick profits. It's an emotional trigger. Now, it's an emotional trigger that the insiders and market makers understand extremely well. They use it every day of the week, and they will use it on every single piece of news data, news items, political news, events, whatever it may be, rumor, speculation. It's all there, fair game, because they understand the power of a fast-moving market and the power of a volatility trigger. And if you're a volume price analysis a student or you use that as your methodology, you will also see through the prism of volume the participation of the market makers with spikes in volume, which are associated with the volatility trigger. And that's the reason we developed it. It's a very simple indicator. So what can you expect to see once it's triggered? Primarily two things. You will either see congestion following into the spread of the candle, or you will see a reversal. Now, in terms of the actual trend, if you see a volatility trigger and you see congestion, it does not automatically mean there is going to be a reversal. What it does mean is you're looking either for congestion and a reversal in the trend. But equally, if you see congestion, the trend, the original trend direction may well continue. And once it has broken away from the spread of that particular candle, then you can assume that that volatility has expired from the market, it's been expunged from the market, and we are back to normal price action as you would expect for that particular chart. So it's an immensely powerful indicator. It works in all markets, all time frames, And if you're in the market and you have a volatility trigger which works in your favor, then as we always say, it is best to close out that position. If you're scaling out, by all means leave some of the position on the market, perhaps close 4/5 of it, something like that. But if you're only trading single lots, then it's best to close out, take your profit off the table. If it does continue in the same direction, the cost of trading is negligible nowadays. You can jump back in. If it's congestion and then a reversal, then you're happy days, and you've banked that particular profit for that particular trade. If you're in a loss-making position and you get a volatility trigger, you've got a decision to make. That's a harder decision. So that's the introduction to the volatility trigger, the volatility indicator. It is a very simple, superficially simple indicator, but it is immensely powerful. It will save you a huge amount of emotional grief, and it will also save you a huge amount financially by just waiting for it to pass, seeing it trigger on the screen, watch the price action, because trading success is all about anticipating price action. If you've got an indicator that's going to give you a pretty good insight into what is going to happen next, and that's what the volatility trigger does, it tells you what's going to happen next. It's immensely powerful and immensely helpful in avoiding those FOMO moments which we all suffer when we want to jump in and we know we shouldn't, but we can't help ourselves. It's as simple as that. Hope you've enjoyed this particular video on the introduction to the volatility indicator for TradeStation. We'll go and look at some examples of it in action. So thanks for watching. See you again soon, and bye for now.